All right. Good day, everyone. Good evening. Nice to see you all again today. So, yesterday we talked about forex. What was forex? What is forex? That forex is gotten from the word foreign and exchange. So that's forex. Explained what goes on in the forex market, the what's trading on the forex market, and all. So today I'll be going through the genesis of forex trading. Because yeah, I want to try and do something, right? If you're with your PDFs, you should go on genesis of forex trading. I'll try to see if I can cover genesis of forex trading, spread, lot size, leverage, and forex sessions, and if I can also cover types of charts at the same time today, right? I'll try to be as brief and straight to the point as possible. And also try to explain it in a way that everyone can understand also. All right. So okay, before I start, I want to ask if anyone has any questions concerning last class. Anything you don't understand, any issues, any questions at all. All right. So no questions. So all right, let me move ahead. Let me go on. So now I'm going to Genesis of Forex. So now, before now, Forex has been traded in various ways from the ancient times. We have the Middle Age and the 19th century, and where we are at the rise of electronic trading, right? So I'll be reading from the PDF. So what I always try to do is this: that in every class I explain what was given in the PDF, because the PDF I simply wrote all those PDFs and explaining every topic to the simplest form, right? And I also try to make use of reality of what you can see in real life to easily understand the topic. So now, talking about the genesis of forex. Forex trading is well, foreign exchange trading has a rich history that dates back centuries. Here's a brief overview of the genesis, right? So now we have the ancient times, right? In ancient time we had the barter system. Before before currency, ancient civilizations engaged in barter trade, exchanging goods directly, right? So there's always change of barter. If you study economics in the secondary school or still in the university, there's always have change of barter before we had currencies. The people had means of what they exchange for. So if you have something, someone had to exchange a certain item you have for a certain item they need, right? So that was we had the barter system. Then we had the currency development, where introductions of coins came about around 600 BC in Lydia, that's Turkey now, known as Turkey, and which marked the beginning of standardized currency, right? So now, outside the ancient times, coming to the Middle Age. In the Middle Age now here, we have where we traded gold. That's where gold and silver came in. Precious metals, they became widely used as currency, facilitating international trade, right? People started in the Middle Age, like after the 600 BC, where they were trading using change of barter, and the coins came out. Then the coins came out. Gold and silver came out in the Middle Age, right? People were using gold and silver as means of exchange, and they were using it to facilitate international trade in the sense that they were giving it a fixed price in the sense that since they're using this as an exchange, right? Since they're using this as an exchange, a fixed amount of piles of gold worth a certain thing, like let's say it works certain acres of land, worth certain number of cows or sheep and all, right? So they still in the Middle Age, the exchange rate. As trade expanded, merchants began to establish exchange rates between different currencies. So when as the trade expanded while using the silver and gold as that those are the precious metals they were using as currencies, the merchants began to establish exchange rates, right? This currency, this will have their own rates. If you're coming in with gold or silver to my country, this is what a pile of gold is worth, a bag of gold is worth 6 cows, 7 cows. If you're going to England, that pile of gold is worth this and that, is worth 3 bags of rice, like for example, and all. So now that's that. Then moving down to the 19th century, right? Moving out to the 19th century. Gold standard. Many countries adopted the gold standard, linking their currencies to specific amount of gold. This created a more stable exchange rate system. So now, the issue of let me explain this better. Of the issue of that gold is like a safe haven for currencies. Like during this Ukraine war, right? Most of the Ukrainians then they were converting their currencies to gold to travel out, to buying gold bars, like a safe haven, right? So now, so in the 19th century, so many countries adopted gold, gold as a standard, right? And also linking their currencies to gold, saying that okay, now instead of using gold as the exchange, gold and silver, saying that certain piles of gold worth 3 cows or 4 cows or ships or flocks of sheep or acres of land, right? They said that let's carry our currency pairs. Let's say 5 coins of our currency pairs is worth certain piles of gold, or certain piles of gold or silver is worth certain piles of coins in our own country. That's what it just means there. So that's what happened in the 19th century. So and also that's where in the 19th century we have where the banking system emerged. That's when the central bank became began to emerge, playing a crucial role in managing national currencies and exchange rates in the 20th century after the 19th century. Then still in the 19th century, we had the Bretton Woods Agreement 1944, which is an established fixed rate pegged to the US dollar. So certain countries which was convertible to gold. The system was lasted for until the early 1970s. Like that agreement was like how am I going to put it? Like okay, just like we have the okay now mostly everywhere they are using gold as like it's a universal currency. They are using sorry USD as a universal currency in the world, right? Everybody wants to know the worth of a particular item in USD, better off USD. So now it was tagged it was tagged that each currency, each country had a fixed exchange rate pegged to a dollar, right? So each country was that if let's say naira to dollar five, a dollar to naira five, a dollar to naira 5 naira, right? Let's say then a dollar to pounds 5 pounds and all, which was now convertible to gold. So now they're giving you options that you can trade this your gold to USD to convert it to your currency, right? This I think this is one of the things that also pushed the USD, the United States economy as at then. So floating exchange rates in 1971, the Bretton Woods system collapsed, leading to floating exchange rate system where uh, currencies fluctuated based on market forces. So still in that 19th century, but after the 1970s, the 1971, the Bretton Woods system collapsed, leading exchange rate system where leaving a floating exchange rate system Do you understand? Float exchange rate system in the sense that each currencies now, right, had the right, the power to have different prices backed by the law of demand and supply. This is where the law of demand and supply came in. That's if you read what I wrote here, floating exchange rate in 1971, the Britain's Woods system collapsed, leading to the floating exchange rate system where currencies fluctuate based on market forces. So market forces, I explained market forces the last slide. Market forces like you have the people, the banks, the those are the hedge funds trading with huge capitals. So now when the Britain Woods system collapsed, it gave room for those forces to push the market. So now the market was the prices of, let's say that the price of USD, one USD to Naira was based on the market forces, demand and supply. Who is buying, who is selling dollar, who is buying dollar, who is selling Naira, who is buying Naira. You get how much volume are they buying with these currencies to inflate the price, right? So that's when that opportunity came in 1971. So then here we are when the rise of electronic trading, where we have the technological advancements that happened in the um the late 20th century. The technological advancement. The late 20th century saw the rise of electronic trading systems, making forex trading accessible to retail traders and 24-hour markets, the globalization of finance and the advent. So the rise of electronic trading just our era now, where we are. The rise of electronic trading where we could now use our mobile phones and access the market, right? We can access the markets. Now, if you go to the banks, how the banks trade, the banks don't trade the way we trade. They don't trade, they don't analyze the market. Let's say now if let's say I don't know if you guys are still with me. Let me check. Okay, you guys are still with me. So now let me go. If okay, like this trade I'm on now, right? I'm buying the card against the odd. So now, as a retailer now, this is what we are doing. We just enter the market through our broker and place a trade, a buy. So I'm expecting price to do what? To come, to move from here over here. You get me? I'm expecting odd here. Odd is Australian dollar to be weak and CAD to be stronger, Canadian dollar to be stronger, right? But now, instead of the banks to do this to buy, what the banks will be doing is they'll be converting, right? They'll be converting their odd to CAD. They'll be selling it off. Now, you see someone have 500 million Australian dollar, you send it to a Canadian dollar account, right? That's how they do it. You get me? They don't just play straight. They don't that's how they were doing it back then. So now since since we're in a digital age, right, where rise to the electronic trading came in, where you can use your mobile phones and access the market 24 hours, gave rise to us the retail traders to also participate in the buying and selling and predicting of speculating of price movement, currency pairs, which we are in now, right? So forex trading has evolved from ancient barter systems to sophisticated global markets driven by technology and economic globalization. Simple as it is. So now let me talk about the participants in forex trading. I talked about that yesterday. The central banks. These institutions influence exchange rates by buying and selling currencies to manage their economies, right? They, they aim to maintain stable currency values, control inflation and support economic growth. Well, yeah, that's what the central banks are for. But Yeah, lately the Central Bank of Nigeria hasn't been doing his work. I don't know, the boards that are there, they are not doing their work. I feel maybe they're selling off the naira due to some negotiation, but I give him good thumbs up because he has cleared our loan with is it IMF, something like that, cleared the loan. So then you have the commercial banks. These facilitate transaction business for individuals acting as intermediates in forex trading. They provide service like currency exchange, foreign currency deposits, and foreign currency loans. Your commercial banks are like your Zenith and Zenith Bank, Union Bank, or the rest, right? So your Zenith Bank, I think Zenith Bank, UB, is it UB or GTB? They also operate internationally, like across Africa. So if you travel across Africa and there's a GTB bank, you can easily withdraw your Naira account using a MasterCard to the currency of the country you are in, or something like that. So that's where your commercial bank come in, and your hedge funds investments that I explained, hedge funds, investment banks, these are large institutions. These are large institutions utilize complex strategies to profit from currency fluctuation. They often employ sophisticated analytical tools and risk management techniques. Right? I've explained about what hedge funds is in the previous class. They are an organization, a company. They get huge bulk funds from companies and trade for them. So they take it as investment. They use to trade the stock market, the forex market, whichever crypto, whichever they find interesting, and they are big traders, heavy traders. Why? Because they enter the market with a huge volume. They don't trade with $2,000. They are trading with 500 million, 300 billion, and all. Then we have the retail traders, market participant. That's us now. Us that we are trading with from 100 million down. You're a retail trader. 100 million dollars down. You're a retail trader. So retail traders, these are individuals who trade currencies for personal gain. Remember, the hedge funds, they're not trading for personal gain, they're trading for the gain of the company and the investors, those that invested to them. But as a retail trader, you're trading for your own personal gain, for yourself and for you alone. And this typically involves using online platforms. They may engage in short-term and long-term trading strategies based on their individual financial goals and risk tolerance. All right, so that's that for the genesis of forex trading. Remember, your brain gets stronger every day when you exercise it. The stronger it gets, the more money you can make. I can make. So, does anyone have any questions concerning genesis of forex trading? Anyone? All right, nobody. So let's go to spread, lot size, and leverage. I don't know if they know we are active, but let me tell them. All right. So going to PIP spread, leverage, lot size, forex sessions. All right. So now talking about PIP. PIP is an acronym for percentage in point or price interest point. Percentage in points or price interest point. A PIP is the smallest or whole unit price move that an exchange rate can make based on the forex market conversion. Most currency pairs are priced out to four decimal places and in a single pip. So let me show you what pips are. Um, okay, a pip is the smallest unit which a currency pair exchange rate can change. It can be also be said to be a standardized unit of smallest amount by which a currency pair's worth in forex market can change. Right, so now let's go to chart. Now talking about pip. Now this let me go back to definition. is the smallest unit in which a currency pair smallest unit in which a currency pairs exchange rate can change. So now this is the smallest unit. You have these units over here, right? So now this trade I am on, right? From here, from here, I mean from here to here, right? Is 29 pips. It's 29 pips. See it here, 29 pips. So now that's to tell you that the the movement, the exchange, right? Remember, we are buying and selling. The exchange moves. I can't see my screen. Wait, can you guys see my screen? Please, someone should unmute on top. Can you see my screen?
No, 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 no.
You can't see my screen.
Yes, yes, you can see.
You can see my screen. Okay, can you see the chat now? Hello.
Yes, you can see your chat, but then I'm sorry, your screen on the Telegram this thing, but the chat we've not seen it.
Oh, okay.
No, we
Sorry
can't see.
about that. Okay. Can you see the chat now?
Yes, yes.
Okay, please. I appreciate you guys should voice up when you cannot see my chat or cannot hear me, so that I can know. Or preferably as the person sent me a text. Who sent me the text? Thank you. Okay, now, so as I was saying, talking about the pips. Now, the movement from here, the exchange happens from here to here, right? On this chart is 29 pips. Hold on. But you guys can see my screen now, right?
Yes, we can see it.
Alright. Let me tell this guy to come back online. Alright. So what I was trying to say is this. Now the movement from here, from this point, right? From where I have this line, let me take it. From where you have this line, the movement from where you have this line to here, right, is 29 pips. So now the movement from here, from this place where I'm expecting price to buy up here to here is 95 pips. Look at already. Normally there's a way to calculate this. You calculate based on your entry price. Like for me, let me exit this. Like for me, this is my entry price here. So I'm to use this price here, the one with the black cursor, that's 0.89169, right? This black cursor. Now, normally I think it's minus it with this one with the price here, and to give you how many pips it is. So I think let me try a calculator. No, but you guys can try it out. Is you minus this from here and you get this, and the same thing here, but same thing here, you minus this with this, you get it, you get the you get the 29 pips they are showing here. But already the chart, there's a tool that can help show you how many pips you are targeting, how many pips will be created once your trade goes your direction or once the exchange has been made. Because remember, what goes on here is just simply buying and selling, buying and selling. The sellers are taking over now. The buyers are taking over, right? So let me go back to sorry. All right. So back to over to pips. That's exactly pips the difference, right? The smallest unit in which a currency pair exchange rate where the price is changed. So going over to spread. Spread is the represent the difference between the bid and ask price. Spread how will I do this? Okay, let me go back to Chrome. I don't have this thing. Sorry. Let me go back to Chrome. Let me share. Okay, preferably let me do it this way. I hope you guys can see my entire screen.
Yes.
No, let me check. Meta 5. Okay. Okay. So I don't really have Meta 5 on my system, but I have that on my phone. And I'm trying to show if I can show you guys the difference in bid and ask price. Difference in pictures. Alright, let's see. Hopefully, Google will show us. Um, okay, I've gotten a good example, but it's not what I really want. But let's use this. Now, right. Now, once you're on your Meta 5 is an app where you access the market, right? Are you guys with me? All right. Are you guys with me? Are you guys with me?
Yes. Yes, sir.
Oh,
Yes, yes, yes.
okay. Okay. So now on your Meta 5, there's a difference where you have two lines. You see a blue, I think is either blue or green. Some depending on how you set it. There's red and green. So you have the red line is the bid axe, the bid line. Then this is the axe line. So now the difference in this line, this space, there'll be a space. That space, right, is your spread. Is what we know as your spread, right? So the difference in the bid and ask price is your spread. So what is the bid? What's the meaning of the bid and ask price? The bid price is the buy price, and the ask price is the sell price. The bid price is the ask price. This price is the asking price. This is the sell price. Sorry, the bid price is the buy price, and the ask price is the sell price. This ask price is the sell price, and this side is the buy price. So if you're going to buy a currency pair, this is the price. This is the best price available around this region. that your broker will give you. If you're to sell, this is the best price around this region that your broker will give you, right? Once we get into Meta 5, you guys will understand more of how that part works. So now the difference in that the space, this space in between, now what they call spread. The space in between is what we call spread. All right. So I gave a detailed concept, the concept of bid and ask price. I gave an example of how the prices work, so you guys can go through it. All this is I used my own initiatives to break this down. I also had to use when dollar was 650 as a then, and I explained everything concerning the bid and ask. So now let's go to leverage. Talking about leverage, right? Leverage involves, please, whose mic? Someone's mic is on. Please, can you mute yourself? All right. So now leverage. Talking about leverage. Leverage involves borrowing a certain amount of money needed to invest in something. In case of Forex, money is usually borrowed from a broker. Forex trading does offer high leverage in the sense that for an initial margin requirement, a trader can build up and control a huge amount of money. So now let me talk this leverage. What I'm talking about leverages. I told you guys yesterday that in US you cannot trade with like $100, $10 like we have here in Nigeria. It's from $1,000 up, and $1,000 there is like trading with $10. So it can't really do anything for you. So there, trading is like you need to trade with your. That's why most of just your celebrity traders abroad in Miami and all, where then they'll say I started trading with 1K dollars, started with 5,000, I flipped it to this, I used 1K dollars, I did this and that, right? So now in Nigeria, the leverage we give here in Nigeria, right? What leverage is simply giving you a borrowed funds to trade. Speculating, giving you a borrowed funds. Like let's say you're trading a $100 account, $100. Okay, let's say $1,000 account. Let's say you're trading. Okay, I explained it here. You're trading $1,000 account, and you're using a leverage of 1:100. So that means this 1,000 times 100. So that means in the market, right? In the market here in the market, what they see you they see you as someone that is trading $100,000 account because of your leverage that times x your money times 100, 1:100, right? So it can give you control 1:100. I think that would be 10, like is it 10,000 or 100,000? So that's giving you more leverage in the sense that there are some trades, there are some markets, I don't know, but as you guys progress, you see that once you fund your broker and there's some currency pairs you want to trade or there's some trades you want to take, your broker will tell you not enough money or not enough leverage, or sometimes they'll send you an email and tell you margin call, right? So your leverage, this is what brokers do. They give you leverage that can help sustain that your $10, that your $100. Let it look like huge money in the market. Remember, I told you the market is controlled and traded with huge volume. They're trading $6.7 trillion every day. Every day is traded. People are losing and people are making, right? Every day. So you where they carry $100, how much is 6 trillion dollars to your $100? So for that your $100 to have at least weight, to have a meaning in the market that you can trade effectively, that's where your leverage comes in. So every broker gives leverage to their clients, right? So now coming to lot sizes, coming to lot sizes. Lot size is commonly traded in specific amounts called lots, basically a number of currency units you will buy or sell, right? So now a lot size is position, a size you're willing to take on a trade when exchanging a currency. So let's say, for instance, like like this trade now that I'm on, right? And now I'm using a lot size of 0.0. I better have a video of I explain lot size. Using a lot size of 0.01 or 0.10, right? Using a lot size of 0.10, it's telling me that for this 0.10, I'm using for this 0.10, I'm using 10,000 units of the base currency to trade. While for a standard lot, I'm using represents 100,000 units of the base currency to trade with, right? Then for a micro lot, 1,000 units of the base currency to trade with. By understanding lot size placement is not something that's very difficult when it comes to trading. As a trader, once you're using your your Meta 5, now technology has made everything easy. All this, there was a time you had to be calculating your lot size, but now once you enter Meta 5, you input the trade you want to take, and you can easily use your this thing to set the lot size to what you want, and know how much you risk, and know how much calculate the pips you make at once. So all that is simpler now, but just to get the basic knowledge about lot size, you know that you have the standard lot size that is 1.00 is the highest, but standard means that if you're trading one lot size, a standard one, or you're trading standard two, standard three, standard four, standard five, then you have the mini lot that is 0.10, 0.20, 0.50, 0.30, 35, 20 something. As far as there's a zero, then decimal points, then that's the mini lot size. Then the micro lot size is 0.01. That's the least every broker can trade. The only place you can trade lower than that is where you have the derivative market. That's where you have the trading the synthetic markets, and also that's where you can trade 0.005. I think 0.005 is the least you trade there. So while we are going to do a live training before the class, before the whole class ends, then I'll summarize this, not today, but before we are done with the beginners, we do a live training so I can explain better of the spread, the loss and the leverage, so I can see it in real charts and real time how it works. It's not really hard, it's something really simple. Forget the big grammar or everything I write, but I'm just trying to explain it to the simplest. So then the relevance of lot size in forex trading, it determines the volume of a trade. Yeah, it determines the volume of a trade and directly impacts potential profit and loss. Your lot size determines how much you're going to lose on a trade, how much you're going to win on a trade, right? Impact your profit and loss. I gave example here. Then also your lot size also directly impacts your risk per trade, how much you're willing to risk. The larger the lot size exposes you to greater risk, and even if the peak movement is small, even in a one peak market move, your lot size is very big. It determines a great risk for you, because the bigger your lot size, the bigger money you're going to make or you're going to lose, independent of the pips the market move, right? Okay, so explain a lot of things here. That I explained trading sessions. We have different trading sessions. A forex session refers to a specific time periods during which major financial centers are open for trading, impacting market activity. There are three primary sessions. We have the Asian session, European session, North America session, and that's the New York session, right? You guys used to hear the New York Times. So types of forex sessions. Forex session is simply um, different time zones where people they trade. Different time zones, different markets. That there's a New York market, there's a Tokyo market, there's a Sydney market. Nigeria, we know get our own market because our economy is scattered. So, but if we're that good, Africa, we should have our own market, whereby if anybody's trading, they're trading in naira against CDs, They traded against Ghana, well, Sefa. Trade now Cameroon, is it Cameroon that is in Sefa or Benin Republic? Trade against Sefa, Naira against Sefa, and you know that by this time to this time, because our geographical zone and our time, GMT, you know that from this time to this time, these African countries, their markets are open for you to trade their currency, right? So that's the same thing with these currency and forex sessions. So you have the Sydney session, there are key countries where their currencies are traded in this session, where you have the trading like the Australian and New Zealand currencies are traded mostly in the Sydney session. And the Tokyo session, we have the Tokyo session, the type of forex session. The Tokyo session operates from 12 a.m. to 9 a.m. GMT. It sees increased activity in the Asian currencies. That's where you have the Asian currencies, they do well, the JPY, the Japanese yen, the Chinese, this thing, what they call it, their currency. So then you have the London session. The London session runs from 8 a.m. to 5 p.m. GMT. This session is one of the most effective and liquid periods in forex trading. It overlaps with both Tokyo and New York sessions, leading to significant price movement and opportunities. Most traders love trading the London session. Why? Because at that time, you feel, well, not like the feel, something I've also seen. The market is much more opportunities in the London session to trade with. You have a lot of good setups and good entries. Also in the New York session too, operates from 1 p.m. to 10 p.m. GMT. So people like trading in the New York session. Why? Because it's very, very volatile. Highly is known for high volatility, especially during when it overlaps with London session, making it a prime time for traders to look for substantial price action. Many people trade the New York session because it's very volatile. So inside the material, I gave you guys the time zones when these sessions operate, and also tried explaining everything here with interstate popular market. Here in New York, we have Akwa State. There's a popular market stand. If you can read through the PDF, I explained all of that vividly. Wow. Okay. So what mostly happens in each session? The Sydney session begins the trading day with a lower volatility. That is where this one is just explaining what all of them do at the same time, but I've already explained this. I've already explained this. What is this? Why is why is forex session important? Okay, now why is forex session important in forex trading? Because of liquidity, volatility, and market participation, economic data and releases, right? Different markets bring out different liquidities. Liquidity, what is liquidity? Money in the market. So now, let's say someone is trading, let's say, used to say Africa, we had our own um, forex session, our own trading session. You know that during this session in Africa, the Africans, the hedge funds in Africa, they'll be pulling out their funds and they'll be trading so and so volume, right? Same thing with the New York, Tokyo, and Sydney session. That's what happens. So at this different session brings different levels of liquidity, impacting trade execution and spread. Also, the amount of liquidity in the market also influences how volatile the market is. The volatile market we have is the major currency pairs, right? Where you have the Euro, USD, or USD, that the ones that have USD as a base pairs, right? So market participants also have even the centers I gave, like saying when you have if Africa had their own trading session where we say you know that okay at this time all the countries in Africa you can trade their currency pairs at this particular time zone. Their hedge fund traders, their central banks will be active to also exchange their currency pairs. This will now let you know that okay, in the forex session, these people, market participants, these certain people will be participating in this forex session. Same as economic data releases, that's telling you the news that will occur, details, briefings that will happen at that time. Time zones, overlapped opportunities, strategic planning, etc. All these are simply what these are things you expect to happen in the forex market session, forex trading session. Why is it important to trade it? These are certain things that happens makes it important to trade at this particular sessions. There are people that trade only New York sessions, there are people that trade only London session. Why? Because New York sessions you have high volatile markets. Most hedge funds like trading in New York sessions. That's if you're trading forex, but those that trade stock they don't really give a damn about the New York session. But though that also influence their market, right? As a stock trader. So that's that for spread, lot size, and leverage. Now talking to coming to types of chart. Wow, man, time is almost up. Okay. Types of chart. This is not long. This is not much. Okay, let me just go through this. Are you guys with me? Okay. Now types of chart. We have okay, this guy should be buying. I'm expecting this guy to buy. Alright, so types of charts. We have different types of charts when trading. We have the line chart, the bar chart, and the candlestick chart, right? There are three types of charts which people use for analysis. Forex price charts provide the foundation for forex market technical analysis. Remember, I explained to you guys what technical analysis was yesterday. Technical analysis is doing your analysis on the charts here, on this chart here, while fundamental analysis is doing the background on the economy of the current of the currency pair, the economy of the country of the currency pair you're trading. So that if you're trading in USD, you do economic background, what has Trump done, what decisions has he made, what key steps has he taken, right? That's influencing the economy of the country. So those steps taken that influences the economy of the country also influence the price, the speculations of the currency of that country to the forex market when we are trading. So with that information, piece of information, right, you can help speculate price where market will be going to, right? So now, in types of charts, right, you have the line chart, the bar chart, and the candlestick chart. All of this chart, this example of the line chart, right? I gave a couple of the line chart. Then this is the bar chart. Commonly used is all of them do the same thing, just that I prefer the candlestick chart because there's more information given on the candlestick chart. So now this is a candlestick chart. This is a candlestick chart. These are candlesticks. These are candlesticks. So now this is a line chart. I switched it up to a line chart. Let me see where I can. Okay, this is a line chart, right? There are people that use this line chart for analysis. They prefer this. They have studied this, back tested this, and this is what they use to trade, right? I showed you guys what the line chart is here on the material. This is it. So there are people that use this line chart to make analysis, predict price movement, and they trade with it. So there are people that use candlesticks. These are candlesticks, right? Then there are people that use the bar chart. Where is it? Right here. Okay, there is it. This is the bar chart. I don't know if it's visible enough, but this is it. Look, there are people that understand this, understand. So now, what happens? There's something I said. What happens here is that each candle, each bar represents an information. It represents a set of information being held, right? Being done in the market, transactions being done. So same as candlesticks. Each candlestick represents this on the candlestick chart now. Each candlestick represents piece of information. What happened here? What did the buyers do? They were trying to sell or they were trying to buy. What piece of information was happening here? From this, we can tell that from the market here, now buyers took over because the market price went all the way up from here down to here. So what pushed the price here? Remember, I tell you guys demand and supply. The buyers took the price up down here. Oh, okay. So my voice is cracking. Can you guys hear me? Hello.
Yes.
Okay, you guys can hear me. Don't just complain that my voice is cracking. Alright, let me. Okay. Alright, so now let me continue. We have limited time. So let me go to the material. That's a candlestick chart. So now basically what's made up of a candlestick chart? There's the there's a green candlestick, there's a red candlestick, right? Now my chart, mine is purple and somehow gray. So I prefer this color. So now the purple candlestick for me represents the represent the bullish candle. That in this case is the green candle, bullish candle, right? While the gray candle for me represents the bearish candle here. So now when you look at the candlestick, what do you see? You see there's the open, there's a open of a candle, there's a close of a candle, there's a high of a candle, and there's a low of a candle, right? So now here in a bullish candle, the open of the candle is here. You have the open of the candle here, right? See it here on the diagram. The real body, green candle, the green candle, you have the open here. So that's telling that market opened here, price went up here and closed here. So buyers opened the market, took price up here and closed here. While for the sell, you have the open here and the market closed here. Let me go to the root chart and explain further for you guys. Let me do this. Okay. Let me look for a good candle. All right. Here you have it. Now, everybody should pay attention to this candle. So now, for me, I remember I told you guys that this gray candle is my bearish candle, and this purple candle is my bullish candle, right? Okay. So now, in a bullish candle, the bullish candle indicates that market opened from here, price opened from here. As price opened from here, the market went up from here, it go up, come stop for here, right? It go up, come stop for here. As market go up, go stop for there. Waiting to make go stop for there. Buyers push the price from down here. They push and come up, come here. Do you understand? They push the price, come up, come here. So making this candle bullish, buyers bullish. When the market is bearish, that sellers took over. So took this guy off from here and close here. So as market closed here, the next candle opened from here, right? So now for this bearish candle, what happens to the bearish candle? Market opened here in this bearish candle. Market opened here, went up. Buyers pushed the price up a bit, but they couldn't take the price up. So sellers took over, pushed the price down here. But last, market closed here, closing this candle bearish, right? I don't want to switch. I don't want to mess with my settings, but let me see if I can log in to another account. Try to look. Okay, tomorrow I'll log in another account so that tomorrow I'll better show you guys on red and green candle, right? So in a bearish candle, price opens from here, and that it shows that a bearish candle shows that there's a sell action. People sold. You know, I told you market is in the foreign market. It's all about buying and exchanging, buying and selling, right? So now it's showing that in the bearish candle, like let's say this bearish candle from here. Let me take this guy over here. So from here, from here down to here, right? From there down to there, shows that they were selling. Who were selling? Everybody, participants in the market, the hedge funds or the central bank. They were selling from down from here. Everybody they sell, they come down, they sell, they sell. Do you understand? So these bearish candles, this red candles showing that oh people they sell, everybody this one will get 500 million, they sell, this other one will get 600 million, they sell. So as market can't reach this point, you see bullish candles, see bullish candles, see bullish candle. What happen? People start to they buy. People they buy. Now in price come buy, come reach here. Do you understand? Okay. So now once market is buying, what is it telling you that? Now for this candlestick, market open for here. You buy. You go up, come close for here. Then for this bearish candlestick, it shows say market open for here. It go up small or come back down, but every day sell and they sell and they can't stop here. Sell and stop there. Close for there. Then the next candle open. Hope I've been able to explain that. Alright. So our time is up. This is 10. So if there's anyone that has questions, please you should ask. So I've been able to explain the candlestick chart, though I'll throw more light on that tomorrow. That's what I'll begin with. Types of charts, the line chart, bar chart, but I think I've done everything, said everything about the types of charts. So if you have any question or something you're having difficulties with, you let me know. The floor is yours. Any questions? Any questions? Alright. No question. Since there's no question, I'll see you guys in the next class tomorrow, right? Then the recording of this class, I think I'll send it for you guys once I have time tomorrow. I'll forward it to those that need it should DM me on Telegram. I'll send it for you. Alright, take care of you all. See you guys in the next class. Good night.